Markets were expecting the Bank of England to lower rates to 4.5% yesterday, but what they did not see coming was an unanimous decision with two members favouring a larger size 50 basis points rate cut. The reaction was swift. The pound sterling fell as investors priced in as much as 65 basis points of more easing in 2025. Markets cheered the dovish slant and the FTSE 100 closed up 1.21%. Hello, this is Bode Oshosami on Global Business Insights, where we bring more depth to the main business headlines. This is a special episode focusing on yesterday's Bank of England rate decision. Andrew Bailey commented that while they expect to be able to cut bank rates further, how far and how fast will be a meeting-by-meeting situation. The governor also noted that there was a continued temporary short-term pressure on prices attributed to trend of higher gas energy prices and not linked to economic pressures, also not affected by monetary intervention, which typically takes longer to have their impact. Hence, the need to cautiously proceed with withdrawal of restrictiveness. Monetary easing going forward, he said, will be gradual and careful, noting inflation after a temporary uptick will come down to the Bank of England target by 2027. The word gradual is responsive to the disinflation process, while careful recognizes the many risks and uncertainties. He also noted that the impact of US trade policy for now is unknown and so not factored in. He noted that the UK does not have a substantial trade imbalance with the US, adding that depending on which figures you look at, the two countries either have a small trade deficit or surplus. The numbers are almost balanced. He, however, added that even if the UK is not the direct recipient of potential tariffs imposed by the US, the UK will still be affected, and the effect on the global economic growth and inflation would need to be looked at, and a response, when things are clearer, will be appropriately fashioned. As expected, the Bank of England delivered the bad news UK Chancellor Rees was hoping not to hear. That is, the UK economy is now projected to grow at just 0.75% this year, half its November forecast of 1.5%. Let's listen to the governor.
So today we've cut bank rate by 0.25 percentage points to 4.5%. With the progress we've made to reduce inflationary pressures in the UK economy, we've been able to take another step to make monetary policy less restrictive. And this will be welcome news to many. And we expect to be able to cut bank rate further as the disinflation process continues. But we will have to judge meeting by meeting how far and how fast. We live in an uncertain world, and the road ahead will have bumps on it. We expect inflation to increase this year to a peak of about 3.7% before returning to the 2% target. And we will set bank rate to ensure that it does so sustainably. Chart 1, as has come up, shows the development of 12-month consumer price inflation since 2021. That's the white line. It shows how headline inflation fell sharply through 2023 and into 2024 before reaching the 2% target towards the middle of last year. In the shaded area on the right, you can see how we now expect inflation to increase to about 3.7% towards the middle of this year as negative contributions from energy prices, that's the orange bars, first fade and then turn slightly positive, with some further upward pressure from food and goods prices, that's the purple and blue bars. And this is a full percentage point higher than the peak we expected in November. But behind this uptick in headline inflation stands a continued gradual easing of underlying inflationary pressures in the UK economy. And this is the backdrop to our withdrawal of monetary policy restrictiveness and to our policy decision today. As Chart 2 shows, inflation in the prices of services has been coming down since the middle of last year. That's the blue line. In the latest data for December, services inflation fell more than expected to 4.4%. Some of that downside surprise was driven by smaller than expected increases in airfares, which can be volatile. But other measures of underlying services price inflation have been gradually easing too. And higher frequency measures of underlying services price inflation, which can be indicative of near-term inflation momentum, have remained lower than their annual rates. And this points to a prospect of further moderation in underlying services price inflation. The news from other measures of private sector regular pay growth has been mixed. The bank staff's indicator model of underlying pay growth has plateaued recently, as chart 3 shows, but it still points to a lower rate of wage growth, that's the orange line, than the AWE, which is the blue. And both the bank's decision maker panel and our agents' annual pay survey point to a softening in wage growth over this year to just below 4% and 3.7% respectively. So while we expect inflation to rise again over the coming months, it is almost entirely due to factors that are not directly linked to underlying cost and price pressures in the economy, and factors that we expect to be temporary. Chart 4 shows a decomposition of this. The combined effects of regulated price changes and fiscal measures may add around 0.5 percentage point to inflation towards the middle of this year. That's the orange, blue and purple bars. Core goods and food price inflation measures have also ticked up, that's the pink and green bars. But the single largest driver is household energy bills, that's the gold bars. With current expectations for wholesale prices, energy prices may contribute as much as 0.75 percentage point to the increase in headline inflation expected towards the middle of the year. The winter has been colder than expected in Europe, and that has led to an increase in demand for natural gas, while suppliers remain tight. As chart 5 shows, wholesale natural gas futures prices have risen by around 20% since our November report. The increase in European gas prices has led to an increase in the Ofgem price cap for UK household energy bills for the current quarter, and it will affect the cap for the second quarter of this year too, when it's announced by Ofgem later this month. But gas futures prices remain significantly lower than in 2022, and they are little changed further out. While energy prices are volatile and notoriously hard to predict, these are developments that should help to limit further increases in energy prices. Monetary policy cannot prevent such short-term influences on headline inflation, nor should it respond to factors that will fade by the time it takes its effect. But we should recognise that this short-term pickup in inflation introduces some further uncertainty into the near-term outlook for inflation. Today, the labour market is cooling. The context is one of a weakening in economic activity. Intelligence from the bank's agents suggests that firms are increasingly either reluctant or unable to pass through costs to consumer prices, given subdued demand. There are signs that the restrictive stance of monetary policy continues to work to reduce inflationary pressure in the economy. So looking further ahead, as in chart 6, our February projection, which is conditional on the market implied path for interest rates, this suggests that consumer price inflation will peak this year at around 3.7%, and then fall steadily back to the 2% target over the rest of the forecast period. In our projection, the return of inflation to target is supported by an emerging degree of economic slack in the UK economy. Activity in the economy has been weaker than expected last year. We now expect GDP growth to be notably weaker in the near term too, before picking up from the middle of the year. We expect similar growth rates for 2026 and 2027 as we did in November. Our February projection ascribes much of the weakness in economic activity to supply. This means that the more recent slowdown in demand has so far led to only a small margin of slack opening up. The output gap then widens over the next couple of years of the projection to around 0.75% of potential GDP, before narrowing towards the end of the forecast period. This is consistent with current measures of slack in the economy. Both the level of vacancies and the ratio of vacancies to unemployment have returned close to pre-pandemic levels. suggesting that the labour market is broadly in balance. I would also note that the ratio of broad money to GDP, shown in chart 7 here, has returned close to its pre-pandemic trend, though it's also clear that the slope of the current direction of travel is downwards. While we would expect the underlying disinflationary process to continue, the balance between aggregate demand and supply is one of the main determinants of inflationary pressures in the medium term. This will influence the path for bank rate. On the one hand, greater or longer lasting weakness in demand relative to supply would push down on inflationary pressures, consistent with a less restrictive path for bank rate. On the other hand, if supply is more constrained relative to demand, domestic wage and price pressures could be sustained, consistent with a slower path of future reductions in bank rate. There are risks from the global economy too. It remains unclear what form global trade policies might ultimately take, and the MPC's February projection is not conditioned on any change in global tariffs. A box in the Monetary Policy Report sets out a framework for how tariffs could affect UK output and inflation. So let me conclude. Our restrictive stance of monetary policy has reduced inflationary pressures in the UK economy. With the progress we've made, we've been able to take another step in making monetary policy a little less restrictive today. The judgment we will have to make at our future meetings is whether underlying inflationary pressures in the UK economy are easing enough to allow further cuts in bank rate. Some domestic inflationary pressures remain, and may have eased a little more slowly than we expected last year. And that reaffirms the importance of taking a gradual approach to the withdrawal of monetary policy restrictiveness. Bank rate is not on a preset path. With increased uncertainty and risks to inflation on both sides, from the near-term outlook to UK activity and inflation and from developments in the global economy, we must also proceed carefully, judging the evidence afresh at each meeting. Based on the committee's evolving views of the outlook for medium-term inflation, a gradual and careful approach to the further withdrawal of monetary policy restraint is appropriate. And so with that, Claire, Dave and I will be happy to take your questions. Thank you.
Asian stocks closed mixed as investors see chances of averting a broader trade war. In India, the central bank cut its benchmark interest rate by 25 basis points to 6.25%. It was the first cut in almost 5 years to stimulate economic growth and reverse a broad downturn. Meanwhile, overnight in the US, the major index averages were mostly higher. The S&P 500 was up for a third straight session as investors weighed the last batch of corporate earnings. Speaking of earnings, Amazon reported earnings per share up 86% to $1.86 ahead of estimate of $1.49. This was on revenue up 10% over the previous year, and in which we saw the December quarter reach $187.8 billion, higher than expectations of $187.3 billion. The cloud unit AWS grew by 19%, but at $28.8 billion. Amazon Web Services revenue still came in slightly short of forecasts. Lower profits in the current quarter than forecasted also points to ramp up in spending and expenses to support artificial intelligence services. Later today, another market catalyst could be the US January employment report, where analysts are forecasting a gain of 170,000 jobs, down from 256,000 added in December, with a steady unemployment rate of 4.1%. An upside surprise in the jobs report could encourage more delay in easing by the US Federal Reserve. Well, that's all we can take on this special episode of Global Business Insights, focused on yesterday's Bank of England rate decision. You can watch us on Business Day TV YouTube channel Monday to Friday at 11 a.m. West Africa time. Enjoy your weekend and thanks for watching. This is Bode Oshosami. Bye-bye.